In Chapter 3, we're going to be talking about performance benchmarks and other resources that you have at your disposal to learn about your clients. Now we're going to get into some of the numbers and how we know if a bank is doing well. You know, as you hear certain metrics or information about a bank, how do we know if that's a good thing or a bad thing? So we're going to talk a little bit about that. So what you see on the screen here is kind of an overview of the financial industry universe. So we have the pyramid on the left shows the different sized organizations and how the industry is kind of split out. So in that first tip of the pyramid there, that is representative of the large national institutions. So there are actually only 4 banks that exist in that category. They hold on average about $2.2 trillion in assets. Then we're getting into the small national, that's the lower tier there. That's about 35 banks, maybe 1 credit union that matches that criteria, for a total of 36 financial institutions in that tier of segmentation. Then when you look at the regional banks that are typically about 1 billion to 100 billion in assets, there are about 1,300 of those financial institutions that represent about 31% of the financial institution market. And then we're at the bottom in the community classification, there is about 8,700 financial institutions in that lower part that are under $1 billion in assets. So that is a massive amount of small little banks across the United States. And so when you're looking at a financial institution, you can look at it in certain metrics. As I mentioned, there's asset size, there's average deposits, there's average number of branches in a network, and then average efficiency ratio. So we're going to talk a little bit about these numbers. So in the assets, what is an asset? When we say a bank has $1 billion in asset, is that good or bad? Is that small? And what you can actually think about is, well, about $1 billion in asset is probably right in line with like a smaller organization that's starting to become big. They might start to look for other banks or credit unions to acquire as they're in growth mode, right? So that's kind of a benchmark for you guys to know. But when we say asset, we're talking about an item that is in possession of the bank due to the bank. That can include cash reserves, loans, physical buildings, etc. So that's assets. It's basically saying how much money does a bank have. The asset share that you're looking at right there is just a part of the metric on this particular chart. So it's the industry asset share of how these segments are broken out. So for example, in the top tier where you're looking at 4 different banks, 4 different banks represent 34% of the entire financial institution market, and $2.2 trillion. So again, very few institutions have the most amount of money. The average deposits that they have is 1.7 trillion. The average number of branches in their network is about 3,000. And so you could kind of make the argument, and oftentimes we do, that the reason these institutions are so large is because they have invested in their physical footprint, because a consumer typically has more trust in an institution if there is a physical location in their community. And so that could likely indicate why their branches are so large. But that comes with a big expense. And because those branches are expensive, there's an efficiency ratio there. And so an efficiency ratio is a non-interest expense of net income. A lower ratio is better. So it's expenses over income. And so you do want to have kind of a lower ratio in that regard. So you can see that while some of the largest institutions in the US have the most branches, their efficiency ratio isn't the best either. And so that's where you're looking at actually the more regional banks have a better efficiency ratio, probably because they can kind of balance, right, technology with their physical footprint. So we're going to dig in a little bit deeper too into some of these important metrics. There's kind of two main metrics that I want you guys to have as a takeaway. One is the loan to deposit ratio, and the other is the efficiency ratio. So first, let's give a definition about liquidity, though. Liquidity refers to how easy it is to convert an asset into cash. So cash itself, of course, is the most liquid asset. So when you're talking about loan to deposit ratio, or LDR, as many of our banks or credit unions will refer to that measurement as, this measures a bank's liquidity by comparing a bank's total loans to total deposits for that same period of time. So if the ratio is too high, the bank may not have enough liquidity to cover any unforeseen fund requirements, hence the run on the banks. But if the ratio is too low, the bank may not be earning as much as it could on lending. So how do we know what's the right target amount? The target LDR is 80 to 90%. So 80 to 90% is usually a good target for a bank to have. Now, why is that important for us to understand that? Is because Adrenaline can actually help banks acquire more loans through advertising and branding. So if their LDR is off in a certain way, then we can kind of counteract that through advertising more deposits or more loan products, depending on what the bank's goals are, of course. And then when you look at efficiency ratio, this is certainly one to understand about our clients, because this helps us understand how well they're operating, if they're operating efficiently or not. So it's expense over income, or non-interest expense over income. So non-interest expense is really operating expenses like employee salaries, rent, facilities. So these are all the expenses that go into operating the physical location as well as staffing over whatever income that they are getting. So this efficiency ratio measures how well a company uses its assets to generate income. Improved efficiency ratios translates into improved profitability. A lower efficiency ratio means the bank is operating better, but the efficiency ratio of 50% or under is considered optimal. So just kind of keep that number in mind as a benchmark. So 50% is optimal. And Adrenaline can help improve a bank's efficiency by optimizing the bank branches network. And that could mean maybe helping them do some analysis on their branch network to help them just make decisions on whether they should close specific branches and reinvest that money somewhere else, depending on the market demographics and the market conditions. We can help them analyze that and decide where to put those branches and what operating model they should have, or what type of branch design they should have. So a bank branch's design model certainly affects how efficiently they are operating, and that's how Adrenaline can help as well. And we are going to get into a lot more of that in the next part of our Financial Industry 101. So just a little bit about the good to knows, some key takeaways of this chapter. There are over 10,000 banks or credit unions in the United States. The top 4 banks control 35% of all assets in the US. Over 8,000 of those are under of those institutions are under $1 billion in assets. Efficiency ratio target is 50% or less, and the LDR target is typically between 80 to 90%. So that concludes this section. I want to talk to you guys more about resources. So where can you go to learn more about the financial industry if you have questions? So there are some key places I would call out. Number one is our own website, and specifically the BelieveInBanking.com. website. This is where Adrenaline is putting out our own perspective and thought leadership on what is happening in the industry, and you can stay up to date on what those trends and what our perspective is on what's happening. Another is financialbrand.com. This also has a lot of articles, really great information, and a newsletter. So if you don't subscribe, I suggest that you do. And then S&P.com. Adrenaline does have a subscription to S&P, so you can actually get a username and log in to go in and dig into some of those performance metrics in a deeper way for each of your clients. And it also has specific articles related to a financial institution, so we can do a good knowledge research on each of those clients. And then a couple of white papers that I'd recommend is a Universal Banker white paper, as well as a network analysis white paper that Adrenaline has produced. But we will get into more details about each of those things in the next chapter. And then if you do want to go learn more about some of the topics that we discussed here today, this slide actually has some particular links that you can go and watch videos and tutorials that deeper dive into some of these topics if you're interested. And we'll be sharing this document out to all of you so that you can use it as a resource. So that concludes part 1 of Financial Industry 101. I hope that you have learned something new today. Now you are ready to go and take your pop quiz or your quiz in another link. Thank you so much.